Ever struggled with understanding complex accounting concepts? You're not alone. Many grapple with these intricate principles, from accrual accounting to retained earnings. The jargon, the calculations, the laws, it can all seem overwhelming. But don't fret, let's dive into the 10 most difficult accounting concepts and simplify them. Accrual accounting. The method recognizing revenue and expenses when they're incurred, not when cash changes hands. It can be a head-scratcher for beginners, as they're often more familiar with cash-based accounting. But remember, accrual accounting is about timing and recognition. Deferred tax liabilities and assets, future tax obligations or benefits due to differences between financial accounting and tax accounting. It's like balancing on a tightrope, one foot in the world of accounting, the other in tax laws. So, deferred taxes are all about differences in accounting methods. Time value of money. The concept that money available today is worth more than the same amount in the future. This concept can be perplexing due to the intricate calculations and understanding of interest rates it demands. In essence, a dollar today is worth more than a dollar tomorrow. Amortization, the gradual reduction of a debt over a given period. Often confused with depreciation, but here's the difference. Amortization applies to intangible assets like loans, while depreciation applies to tangible assets like machinery. Remember, amortization is for debts, not assets. Cost of goods sold. The total cost of goods that were sold during a specific time period. This concept requires keen tracking of inventory and thorough comprehension of direct and indirect costs. It's like a jigsaw puzzle, where each piece is a cost contributing to your final product. So, COGS is all about tracking inventory costs. Earnings before interest and taxes, a measure of a company's profitability. It's not the same as net income. While net income includes all income and expenses, EBIT focuses on earnings from business operations. Think of EBIT as a company's operational profitability. Capital expenditure versus operating expenditure. CapEx is for long-term assets. OpEx is for short-term expenses. The distinction is crucial as it directly influences financial statements and tax deductions. Misclassification can skew a company's financial health. In short, CapEx is for the long run, OpEx is for the day-to-day. Double entry accounting. Every transaction affects at least two accounts. This concept is a balancing act where one side mirrors the other, making meticulous record-keeping crucial. Think of it as a financial seesaw. So, every debit has a corresponding credit. Liquidity ratios. Ratios that measure a company's ability to cover short-term obligations. Now, these can seem intimidating. Why? Because they demand a comprehensive understanding of various assets and liabilities. But remember, liquidity ratios are all about short-term financial health. Retained earnings. The net income that's retained by the company rather than distributed as dividends. It's a tricky concept as it demands a good grasp of both income statements and shareholder equity. Essentially, retained earnings are your company's reinvested profits.